Without a doubt, we have some significant challenges ahead of us. And while some credit markets may be stabilizing, families, communities, and the economy continue to suffer. Frankly, I think things are going to be getting worse before they get better. As regulators, we continue to see a lot of distress out there. Foreclosures keep rising as mortgages reset to higher rates. Home prices keep sinking, and millions of families continue to struggle with unaffordable mortgages. I can sympathize with these families. I've seen hundreds and hundreds of ordinary people at foreclosure workshops desperately looking for ways to keep their homes. And all of us can see the strain on state and local government budgets and the impact on the banking and financial systems. There is more uncertainty ahead. Data show that there could be a second wave of the more traditional credit stress you see in an economic downturn. Delinquencies are rising for other types of credit, most notably for construction and development lending, but also for commercial loans and consumer debt. The slowdown we've seen in the U.S. economy since late last year appears to be directly linked to the housing crisis and the self-reinforcing cycle of defaults and foreclosures, putting more downward pressure on the housing market and leading to yet more defaults and foreclosures. This is why regulators and policymakers continue to focus on the housing market. We need to find better ways to help struggling homeowners. We need something that is more immediate and more scalable. I think the next line of attack should be using low-cost government loans to help borrowers pay down unaffordable mortgages. We need to take a systematic approach that pays down enough of these mortgages to make them affordable. And I think this can be done at zero cost to taxpayers. The FDIC is suggesting that up to $50 billion in new government loans that would be issued that would pay down a portion of the value of over 1 million existing loans. The Treasury would do a special debt issuance to provide funding for these loans. We're calling these new government loans the Home Ownership Preservation Loans, or HOP loans for short. Eligible borrowers could get a HOP loan to pay off up to 20% of their mortgage. Mortgage holders would get the cash. As they're part of the deal, they would restructure the remaining 80% into fixed-rate affordable payments, and they would agree to pay the government's interest costs for the first 5 years. That way, the HOP loans would be interest-free to the borrower for the first 5 years, and after that, borrowers would begin repaying them at fixed Treasury rates fully amortized over the remaining life of the mortgage. This would give borrowers a breather and dramatically reduce the chance of foreclosures. I think it's time we come to grips with the need for more proactive intervention, and we need to act soon. The housing crisis is a national problem that requires a national solution. It's no longer confined to states that once had go-go real estate markets. Creating additional tools to help borrowers that are cost neutral and are systematically applied makes too much sense not to act upon. The FDIC has dealt with this kind of crisis before. We all remember the S&L disaster of the 1980s and 1990s. Fortunately, we're in a much stronger position today. Banks are healthy, and we want them to stay that way. But we haven't forgotten the lesson, not by a long shot. We learned the hard way that early intervention always costs less and is always better than a policy of after-the-fact cleanup. I hope that that is the path that we follow, and I urge all of you here today to climb on board, help us make the right policy choices, and help restore the American promise.